And let's put the spotlight on IGL. The company did come out with its earnings, but what's the way forward? Let's take it forward with Mr. Kamal Kishore Chatiwal, who is the managing director of the company. Hi, very good afternoon, and thank you so much for your time. Firstly, when I look at your numbers, your growth has been good, but in terms of the volume, we have seen a sequential decline there. Firstly, if we can start and help us understand that what led to this decline, what were the factors that were at play?
So I think what you are talking about is our guidance that we had guided for exit volume of around 9.5, but we have achieved 9.18. But both at sequential level as well as quarter on quarter or even the entire year, the volumes have increased. Like from quarter three to quarter four, from 9.11 we have increased to 9.18. For the full year, 8.43 to 8.99 or 9 million. So that has been the kind of growth, and on quarter, 8.73 to 9.18. So overall, there has been an increase. There has never been a decrease in the volumes. But yes, our guidance was for 9.5, and we have achieved 9.18. So there has been a slight miss in that sense.
Right. Also, sir, tell us what will be your volume guidance for FY26? What are the new areas for the company that you will be eyeing in FY26 to get incremental volume growth from?
Yeah, for FY26, we have targeted for 10 MMSCMD of volumes. Now, our PNG segment continues to grow at around 10 to 11%. Both the industrial as well as domestic is very robust. And that segment we are targeting, and we are sure that that will continue to grow at 10 to 11%. CNG segment, Delhi is growing at around 3 to 4% because it is absorbing the loss due to DTC volumes. The volumes remaining of DTC are very less, only 1.1 lakh is remaining. So we are hopeful that Delhi will also continue to grow at around 5 to 6%. NCR is growing at around 15-16%, and outside NCR areas are growing at around 28 to 30%. So we see that growth continuing in the next 2 to 3 years, and that is the areas that makes us confident that we'll be able to achieve 10 MMSCMD.
Certainly, Mr. Chatiwal, Delhi and NCR is one of your major markets, but given the fact that Delhi government has come out with their draft EV policy as well, if that gets accepted, help us understand that how do you foresee that impacting your business and also your volumes?
We have made our submission to Delhi government that gas was brought in after Supreme Court intervention to be a bridge fuel or a transition fuel to much more cleaner fuels. So we have submitted that it should remain a transition fuel. It should not be clubbed with the other more polluting fuels like petrol and diesel, which it is replacing. So it cannot be clubbed with that. And if you look at the entire emission life cycle emission of both EV as well as CNG, I mean, whatever electricity that the EV space is using, is 80% of that is from solid and liquid fuels, fossil fuels. So similar is the case with gas, that if you use gas, you are giving the benefit of 20 to 30% as compared to petrol and diesel in terms of the carbon emission. So it is much more closer to the EV space in terms of sustainability aspects rather than petrol and diesel, because it was brought in to replace those two fuels, and it cannot be clubbed with that. And the choice of using the fuel should be left to the consumer. And we will support the government in whatever sustainability initiatives they are taking to make Delhi cleaner. So that has been our submission, and we are hopeful that the government will look into all aspects before taking a decision.
Right. So, sir, the APM gas allocation has been reduced by 20%, and the company has taken a price hike of 1 rupee. Given this context, what will be the outlook on the margins? Is the price hike enough to absorb the full impact of the APM gas allocation reduction?
You see, yes, you're right that we have taken a very, very small increase of 1 rupee in Delhi, 3 to 4 rupees outside of Delhi. So that is not enough to absorb the full impact. So currently we have a 58% is APM for CNG segment. Out of that, new well is 1/3. 2/3 is the APM allocation and 1/3 is new well gas. Now, new well gas pricing is 20% more than the APM ceiling, APM price. So that makes the entire mix, instead of $6.8 per MMBTU, it is at $7.3 per MMBTU, 7.2, $7.3 per MMBTU due to the new well component. But still, this gas is very, very competitive. The mixture of APM and new well gas is very competitive as compared to the gas available in the spot market as well as the long-term, medium-term contracts. So if our concern is much more to do with the change in the mix, basically change in the mix will not make much of a difference, but any reduction in the domestic volumes. So we need some time to source that additional volume. So that has been our concern. Now, government has come up with a policy that they will be intimating 2 quarters in advance about any change. So that is a very, very good step and a progressive step for the government, that the CGD entities will be knowing in advance so what will be their sourcing requirement. So with that, we feel that now the CGD entities would be much more competitive as far as the gas sourcing is concerned.
All right, we do understand and take your point, but I just wanted to follow up on this. Given the fact that you have already taken a price hike, but you have to absorb some of the impact that you already see coming, will this impact your margins in the next 1 to 2 quarters at least?
You see, margin, we are always reviewing our margin, and our long-term guidance remains 7 to 8 rupees per SCM range. Although in the third quarter, due to sudden decline in APM volumes, it has come down to 4.34 rupees per SCM. So in the intermediate, we have given a guidance that in 1 or 2 quarters, we should be in the 6 to 7 range. And subsequently, the target would remain 7 to 8 range. So now we have come back in the 6 to 7 range. And after 1 or 2 quarters, we will be back in 7 to 8 range. For that, whatever is needed, be it at the sourcing front or a price hike, so we will take all the steps.
Right. Also, a big concern amongst the analysts is that the petrol and the diesel prices have been constant, and the APM gas reduction, CGD companies will not be able to take the price hikes, because if they do, then the cost arbitrage that the CNG enjoys over petrol, diesel will be over. What is your view on the same?
Yes, you are very correct in saying that the attractiveness of the fuel was because of the differential that it was giving. Now, IGL, is in a sweet spot as far as this aspect is concerned, in the sense that we are selling the cheapest CNG in the country at 76.09 in Delhi, whereas the coastal geographies are selling at much more higher. So IGL has a headroom in that sense that we still have not taken much price hike. So we remain competitive as far as petrol and diesel is concerned. If you look at Delhi, so the difference is still 19 rupees. So that remains a very, very competitive plus for IGL as compared to the other CGD entities. So you are correct that for the CGD sector as a whole, this remains a challenge, but IGL has some headroom left for price hike.
But talking about headroom that is left for some more price hike, like you are also mentioning, help us understand how much of the headroom is left and how much price hike is expected in the coming quarters.
I mean, that is a very, very dynamic situation, but we are aware of the fact that we are not only competing with the neighboring GAs, but also with alternate fuels and especially the new fuel, the EV. So we have to remain competitive. Otherwise, that space will be occupied by EV very fast. Because our experience has been that wherever the CNG prices are very, very high, closer to say 95 to 100 range. So there the EV penetration has been much higher, especially in the three-wheeler and taxi space. So because that is losing the competitiveness. So we are mindful of that fact, and any price hike we take has to look at the future growth prospect.
Right. So the PNGRB has initiated a public consultation process to amend the pipeline tariff regulations. How does this impact your business?
So that is a very positive step for CGD entities, in the sense that what they are suggesting or proposing in the consultation paper is that there will be a single tariff for CGD, fuel gas used for CNG transport and domestic. So that is a very positive step, especially for the entities, which are far from the source. So Delhi and northern India is coming in zone 2, zone 3 area. So that will be benefited by this step. That there will be unified a single tariff. So that will make it beneficial for the most of the CGD entities.
All right, and lastly, Mr. Chatiwal, the company is investing 382 crores in the solar plant in the state of Rajasthan through a JV. If you can take us through your overall plans in the renewable segment, what is the plan going forward?
You see, it is related to our, even the country's net zero target and the company's net zero target, that we need to make our operations green. Towards that initiative, our board in its strategy meet has said that we should target 1 gigawatt of solar and solar wind renewable, basically 1 gigawatt of renewable. Towards that direction, this is only 400 megawatt AC and 500 megawatt DC. So that is one such step that we are looking at that, and we will be trying to bring that power as a captive consumption to wherever areas we are using, in Delhi, Rajasthan, UP. So that is our long-term plan, that will help us reduce our costs, not only reduce our costs, but also make our operations greener.
All right, thank you so much, sir, for joining us. We will let you go on that note.
If you like this video, then like, share and subscribe to ET Now.